Stock markets are the place where shares of many companies are exchanged for capital. Companies sell their shares to raise capital to buy goods and services or pay expenses. When you buy stock or shares, you become a stake owner of that company. A good understanding of equity or stock markets can make you a successful investor. You can make an earning by investing your own or by trading stocks. You can also manage a stock portfolio for other people and become a stock broker.
Investors like Warren Buffett and Rakesh Jhunjhunwala have created billions of dollars in wealth because of their deep understanding of stock markets. The first step in deciding whether to buy a stock of a company or not is to understand their product or service.
For instance, the main revenue-generating product of Reliance Industries is its oil refining business. It refines crude oil at its Jamnagar facility and then sells various petroleum products. Such knowledge helps an investor to take an informed decision of investment.
Next is to understand the state of the economy. You will get an idea of the state of the economy by looking at three main indicators. 1. Current GDP growth rate. 2. The current inflation rate. And 3. The current unemployment rate.
A high GDP growth rate is a favorable factor for the economy.
A high inflation rate is an unfavorable factor for the economy.
A high unemployment rate is again an unfavorable factor for the economy. During times of economic slowdown or recession, the risk of investing in stock markets are higher.
During good economic times, the risk of investing is lower. Do you prefer a constant stream of income from your investments? Or do you prefer growth through capital appreciation in the price of your stock? You can get a constant stream of income in the form of dividends when you invest in companies like Infosys.
On the other hand, as long as its founder Steve Jobs was at the helm, Apple did not pay any dividend. Investors in the stock of Apple made money by the capital appreciation in the price of its stock. So it was like they bought the stock of Apple for $10, then they sold it when its price rose to $30. Thus, they made money. So, if you are a growth investor that is seeking capital appreciation, then Apple is the right stock for you.
Before you start investing, know your risk tolerance. Equity investments have always been risky. So, if you can tolerate a high level of loss without incurring any substantial hardship, then your risk tolerance is high. Otherwise, it is low. When you have a high risk tolerance, you can invest in cyclical stocks. They are stocks of companies whose performance varies significantly in different phases of economic cycles. When the economy is in a boom, the performance of these companies is also good, so their stock price goes up. When the economy is in a slowdown or in a recession, their stock performance is also downwards.
Stocks of hotel companies are examples of cyclical stocks. On the other hand, stocks of FMCG companies are non-cyclical stocks. Stocks of FMCG companies are less vulnerable to changes in economy. Take the example of a company that makes soaps. Its performance is less likely to vary much with changes in the economic cycles. Its revenues are likely to remain stable irrespective of whether the economy is in a boom or recession.
Non-cyclical stocks are safe investment bets, while cyclical stocks are riskier bets. Therefore, depending on your risk tolerance, you can choose a cyclical or non-cyclical stock. Also, you can choose to invest in both of them in a certain ratio based on your risk tolerance. It is a common belief to invest in stocks that are relatively undervalued by equity markets. This is one of the main underlying principles of the investment strategy of Warren Buffett. The price of an undervalued stock is more likely to increase in the future. Similarly, there are greater chances of losing money when you invest in stocks that are overvalued in the equity market. It is commonly believed that the price of an overvalued stock is more likely to go down in future.
So, how to anticipate whether a stock is overvalued or undervalued? One way is to check the price-to-book value ratio of the stock. The price in this ratio is the current market price of the stock. Book value per share is the book value of the equity divided by the number of shares outstanding. Check the recent balance sheet of the company. Balance sheets of companies listed in stock exchanges are publicly available. At the bottom of the balance sheet, you will see a row presenting the shareholders' equity. This is the total book value of equity of that company. Now, divide it by the number of shares outstanding to get the book value per share of that company. You will get the number of shares outstanding by dividing the profit after tax by earnings per share of that company. Now, you can compare the total profit and earnings per share in the profit and loss statement or income statement of the company.
Warren Buffett invested in stocks that had a price-to-book value ratio of 1.2 or less. He considers stocks that have a less price-to-book value as undervalued and more as overvalued. Let me explain how you can put Warren Buffett's principle into use with the help of the following case. Say Wang is an investor who plans to buy shares of roadside supermarts, whose closing price on 10th of January 2023 was rupees 3,078. The total assets of the company until March 2022 was rupees 15,472.64 crores. The total liabilities was rupees 1,794.75 crores. The shares outstanding is rupees 64 crores. Wang is expecting a stable market with not much change in the share price until February 2023. Now, following Warren Buffett's investment principle, Wang calculates the company's price-to-book ratio. He finds out that the current price-to-book ratio of the company is 18.37. This is way higher than Warren Buffett's recommendation of 1.2. Thus, Wang chooses to skip it. Suppose in June 2023 the stock price falls and the price-to-book ratio reaches to 9.47. This ratio is better than that of January's ratio of 18.37. But Wang should still choose to skip it because it is overvalued. Suppose the company made a series of bad investments, and in July 2023 the stock price hits the rock bottom. This will result in a price-to-book ratio of 1.18. As the stock is now undervalued, Wang should consider to invest in it. But what if the company's profits had risen constantly at the rate of 28% every year until July 2023? Should Wang still have skipped it? No, because this situation will be considered an exception according to the 7 investment rules of Warren Buffett. If you would like to learn about Warren Buffett's 7 investment rules, go through this presentation's notes. It is published on the URL provided in the description box.
Furthermore, here are some questions that you should ask before following Warren Buffett's principles. Why does Warren Buffett consider a lower price-to-book value ratio a good thing? Can this rule be applied in the case of companies whose financial statements have not been prepared accurately and fairly? What other measures, beside price-to-book value ratio, can be used for determining whether a stock is overvalued or not? What are the flaws or shortcomings of this investment strategy of Warren Buffett? How can a beginner who has less research and analysis resources compared to Buffett apply this strategy?